Hello everyone, I am Dr. T. Usharani, Assistant Professor, Department of Commerce, Kumaraguru College of Liberal Arts and Science. In this unit, we focus on the concept of capitalization, which is central to a company's financial structure and operational capacity. Capitalization refers to the total amount of long-term funds required to support a business's growth and meet investors' expectations. A well-structured capital base allows companies to maintain stability, growth sustainably, and respond to market shifts. Key topics covered are concept of capitalization, which defines the capitalization and understanding of its role as the foundation of the company's finance. Next, basis of capitalization, which covers cost theory that calculates capital needs based on the cost of establishing the business. Then, earnings theory, which focuses on future earnings potential often used by high growth industries. And over and under capitalization, which identifying the symptoms, causes and remedies will be covered in this unit. Overcapitalization leads to low profitability, while undercapitalization limits the growth potential. Watered stock is also explored to identify the shares that issued without adequate assets backing, often resulting in inflated values. Balancing capitalization discusses on the importance of a balanced approach to avoid financial stability. This unit provides insights into capital management strategies, enabling students to make informed financial decisions essential to any business's long-term success. Moving on to the introduction of capital. Capitalization is the backbone of financial structure, which is the crucial concept in corporate finance. Capitalization determines a company's long-run funding structure, influencing everything from day-to-day operations to long-term growth. Capitalization is a critical financial concept that determines the total amount of funds a company requires to operate efficiently and achieve sustainable growth. It encompasses both debt and equity financing, creating a balanced structure that supports a company's operational needs and long-term objectives. Effective capitalization enables a company to fund essential activities such as acquiring assets, managing working capital, and expanding operations. Additionally, it plays a significant role in shaping investors' perception. An imbalance in capital, whether excessive or insufficient, can impact the company's market valuation, stock price, and overall credibility. A well-managed capitalization strategy ensures financial stability and positions the company for growth, while poor capitalization practices may lead to financial instability and hinder potential of the growth of company. The appropriate capitalization structure varies depending on the company's industry, growth stage, and the risk tolerance. Let's begin with an example to illustrate this concept. Reliance Industry is a prominent Indian example of a well-capitalized company. By efficiently managing its capital across telecommunications, retail and energy sectors, Reliance has positioned itself as a leading player both domestically and globally. Its robust capital structure has allowed it to invest in large-scale infrastructure and grow its market shares in multiple sectors. Let's explore another example. Tata Motors, operating in a capital-intensive automotive industry, uses capitalization to fund its high-cost manufacturing infrastructure, R&D and marketing. For Tata Motors, balancing equity and debt is critical for maintaining financial stability and supporting its global operations. Cost theory versus earnings theory. Companies typically choose both two bases for determining capitalization, cost theory and earnings theory. Each theory offers a unique perspective on calculating capital needs. Cost theory and earning theory are foundational approaches to capitalization. Cost theory estimates capital based on the initial investment required to set up and run the business. In contrast, earnings theory bases capitalization on a company's projected future income, making it more suitable for companies where growth potential drives value rather than fixed assets. For example, to better understand this, let's consider the following. Tata Steel's a manufacturing giant primarily uses cost theory due to significant costs involved in purchasing machinery, raw materials and setting up production facilities. On the other hand, Infosys, an IT services company, uses earning theory because its future income from software and consulting services outweighs the importance of physical assets. Each theory aligns with the specific operational needs of these companies. Let's proceed to the discussion on cost theory. It is a capitalization approach based on the initial investment required for a business, especially relevant for asset heavy industries. Cost theory focuses on calculating the capital needed by summing up the cost of physical assets and working capital. This approach is often used by companies that need substantial upfront investments such as in manufacturing, infrastructure and utilities. By using cost theory, companies ensure they have sufficient funds to cover startup expenses and maintain operations. Let's take a look at an example to make this clearer. Steel Authority of India Limited exemplifies cost theory. As one of the largest steel manufacturers, SAIL requires massive investments in machinery, land and equipments. The company's capitalization is thus based on the substantial capital needed to operate efficiently. Cost theory provides SAIL with a clear view of the capital required to sustain its high cost infrastructure and asset base. Now let's move on to the earnings theory. In contrast, bases a company's capital needs on its potential to generate income, focusing on future profitability rather than current asset costs. Earning theory calculates capitalization based on anticipated income, projecting the company's ability to generate future profits. This approach is forward-looking and often appeals to service-oriented or intellectual property-driven sectors where physical assets are less crucial. Earnings theory can attract investors looking for long-term returns based on a company's earnings potentials. Here's an example that can help clarify this concept. Infosys, one of India's premier IT companies, uses earnings theory. Its capitalization is largely determined by expected income from future contracts, making it ideal for attracting investors focused on growth potential. Infosys' capital needs are driven by the revenue it expects to generate through software services, consulting and digital transformation projects. This approach aligns well with the IT sector, where profitability depends on expertise and future client demand rather than physical infrastructure. Many companies blend cost and earnings theories to achieve a balanced capitalization structure that accounts for both current assets and future earnings. Balancing cost and earning theories allows companies to optimize capitalization by factoring in both upfront investment needs and future income potential. This approach ensures they are neither overcapitalized nor undercapitalized. A balanced capitalization approach can also offer greater flexibility for companies expanding into new markets or innovating in their industry. To demonstrate this, let's explore an example. Reliance Jio successfully uses a balanced approach. Initially, Jio invested heavily in telecommunications infrastructure, that is cost theory, but it also considered future revenue from data services, that is earnings theory. This blend allowed Jio to quickly gain a large market share, offering affordable data services and expanding across India's vast telecom market. By balancing cost and earning, Jio has sustained rapid growth while managing its capital efficiently. Next, move on to the overcapitalization. Discuss on symptoms, causes and remedies. Overcapitalization is a scenario where a company has more funds than it can effectively use, leading to inefficiencies and financial strain. Overcapitalization happens when a company's total capital exceeds what it actually needs to operate effectively. Symptoms include high debt levels, falling share prices, and an inability to generate sufficient returns. Causes can range from overestimating capital needs to poor management or changing market conditions. Overcapitalization can create pressure on the company to generate higher returns which may not be feasible. Let's take a look at an example for better understanding. Air India is an example for overcapitalization. Despite significant funding, the airline struggled with high debt and declining revenues. Symptoms like falling profitability, operational inefficiencies, and difficulty in paying interest and dividends became evident. Remedies for Air India included asset revaluation, debt restructuring, and even capital reduction as in sought to align its financial structure with actual operational needs. Let's look on next topic for further discussion on undercapitalization. Undercapitalization occurs when a company lacks sufficient capital to meet its operational needs despite being profitable. Undercapitalization is often seen in fast growing companies that don't have enough capital to keep up with demand. Symptoms include high profitability but limited capacity for expansion or scaling. Causes can include conservative financial planning, rapid demand growth or undervaluation of assets. Remedies involve raising additional funds through new shares, securing external investments or reinvesting profits. Here's an example that can help clarify this concept. Ola Cabs experienced undercapitalization in its early stages with high demand but insufficient capital to expand operations. Despite its popularity, Ola struggled to add new drivers and enhance its technology due to limited funds. By securing additional funding from investors like SoftBank, Ola was able to address its capital need, expand its fleet and improve infrastructure. In this slide, we will take a closer look at the watered stock. Watered stock refers to shares issued without adequate asset backing, often resulting in diluted value for existing shareholders. In case of watered stock, companies issue shares at inflated asset values or without sufficient real assets, leading to misalignment on the balance sheet. This practice can weaken investor confidence and create financial instability if shareholders' equity does not match the real asset value. To demonstrate this, let's explore an example. Some real estate firms in India have faced scrutiny for issuing shares based on overvalued land or buildings. By artificially inflating asset values, these companies risked investor trust and faced difficulties when actual asset values were realized. Watered stock creates a mismatch between the shareholder equity and real asset, reducing the company's financial transparency. Turning to the next slide, it is important to distinguish between watered stock and overcapitalization, as each has unique causes and impacts on financial stability. While watered stock involves shares issued without adequate asset backing, overcapitalization is a broader financial issue where the capital raised exceeds operational needs. Overcapitalization affects overall company performance and profitability, whereas watered stock specifically affects share value and investor equity. Here's an example that can clarify this concept. In India, speculative markets like real estate can see both issues. For instance, when companies issue watered stock, they inflate asset values, misleading investors. With overcapitalization, firms might have excess funds but struggle to generate returns. Recognizing the distinction helps investors make informed decisions in these markets. So, balancing capitalization ensures companies have just the right amount of funds to operate efficiently and achieve growth. A balanced capital structure is crucial for financial health, flexibility and investor confidence. Well capitalized companies can meet operational needs, fund growth and adapt to changing market conditions. A balanced capitalization approach supports long-term sustainability. To demonstrate this, let's see an example. HDFC Bank is a prime example of balanced capitalization in India. By carefully managing its debt and equity, HDFC maintains a stable capital base, ensuring it can fund its growth while safeguarding investors' interest. This balanced approach has allowed HDFC to adapt to market fluctuations, expand steadily and retain investor trust. To conclude, effective capitalization is key to any company's financial stability and growth potential. Capitalization strategies determine a company's ability to operate, grow and attract investors. Through cost and earning theories, companies can find the most suitable capitalization method while understanding the risk of overcapitalization, undercapitalization and watered stock help maintain financial health. As we have seen from examples like Reliance, Infosys and Tata Motors, optimal capitalization is essential for long-term resilience and growth. With a well-balanced capitalization strategy, companies can thrive in competitive markets and navigate economic changes. Welcome to the assessment. This quiz is designed to evaluate your understanding of key concepts of capitalization. It contains 10 multiple choice questions, each with 4 options. Please take a moment to review each question carefully and select the most accurate answer. Best of luck. Today, we have journeyed through the essential concept of capitalization, understanding its foundational role in shaping a company's financial position. Thank you.